Welcome to Supernatural Stocks on Moneyweb with your host, the Finance Ghost. This is your weekly fix of equity analysis designed for stock pickers. Whether local or international, you can expect a mix of news and my ideas about what I'm seeing in the markets. How often have you seen a company talk about achieving strategic focus, or simplifying a group, or getting back to its roots? Cleaning up our balance sheet, now there's a common one. That's one of my favorites. And of course, not enough people tend to ask how it got just so dirty in the first place. And if the balance sheet needs cleaning, you can be almost sure that the share price, that has plenty of messy spots on it as well. Now, I've been lucky enough in my life to spend a lot of time in boardrooms in advisory and strategic capacities, so I've kind of seen how this movie tends to go. Often, the root cause of the problem is nothing more than boredom. Sounds crazy, but bear with me. Perhaps the name boardroom isn't so wrong after all. Imagine the classic scenario with a mature company. The group is working well, the thing is ticking along at inflation plus a few percentage points on the top line, and thanks to strong cost control and discipline, that translates into double-digit earnings growth. Everyone should be very happy with that and should be enjoying their lives. That is what most private companies would do in this scenario. I don't think I've ever met a private company owner who feels irritated by owning a dividend-paying company that is growing at a decent rate and defending its market position. And yet, in the public space, there are very few executives who can bear to deal with this situation. Why is that? Is it the pressure of needing to constantly grow as a public company? There might be an element of that, but there are also plenty of slow growth companies that are seen as appealing investments because the management team can be trusted and the valuation reflects the maturity of the business. There must be another explanation for why an otherwise solid operation gets involved in the wrong stuff. It's a bit like a kid with good marks in high school suddenly making all the wrong friends. Charlie Munger is often quoted as saying that if you show him the incentive, he will show you the outcome. Sadly, the great man is no longer with us to prove his point, but this quote, like the rest of his legacy, will live forever, mainly because he's right. What you incentivize is what you will get. If you incentivize the wrong kind of growth, that's what the CEO will bring you. For example, if a CEO is incentivized by a revenue growth measure that doesn't make adjustments for acquisitions, then guess what happens? That CEO goes and buys stuff. The fastest way to grow revenue is to take your cash profits and use them to buy more revenue, instead of paying higher dividends or increasing share buybacks, or for that matter, investing in your own business to make sure you defend your current position. Now, if you are doing high quality acquisitions, that's not a problem. In fact, shareholders are only too happy to have you hang on to their capital. As an investor, why would you want higher dividends or more share buybacks if the acquisition opportunities are lucrative and beat the cost of capital? The management team in that scenario is doing all the hard work for you. They are finding great ways to allocate capital. Sophisticated investors call these companies compounders because you invest once and let the management team grow your capital at a compound rate for years to come. These companies are rare, unfortunately, and so are the management teams, because of the human emotions that get in the way of capital allocation decisions. When attractive deals are available, it's no issue. Boredom is cured by doing excellent transactions. In fact, what could be more exciting than being seen as a management team that is particularly good at making acquisitions? Just think of the reputation enjoyed by the likes of Afrimat and Bidcorp. They don't wake up in the morning feeling bored, I can assure you. They get to tell great stories of the deals done over the years and how they have contributed to building such strong groups today. I have seen no shortage of market commentators pointing to the timing of Afrimat's acquisition of Lafarge and how well that could work out in the context of renewed optimism around South Africa. But the troubles start when deals are not attractive enough to be justified, yet aren't objectively poor either. Now we are in danger zone. They are there and thereabouts, with the potential to work out, but also a decent risk of failure as well. In these cases, corporate managers should think very carefully about whether they shouldn't maybe pay dividends instead, or better yet, consider whether the current share price undervalues the company and is thus ripe for share buybacks. Unfortunately, not all management teams are willing or even able to do this. It would amaze you how many boardrooms are firmly lacking in investment and capital allocation skills, even at CFO level. For a great example of a powerful share buyback strategy, look no further than Calgro M3 on the local market. The share price is up a whopping 70% in the past year. Yes, they've been a lot stronger operationally than several years ago, But they also did the smart thing and they repurchased their shares when they were trading at a dirt cheap number. It is a much more powerful strategy than paying a cash dividend, and is certainly stronger than making acquisitions that offer less obvious returns than simply buying your own company at a very cheap price. The other example that usually gets used is Lewis Group, famous for ongoing share buybacks that have helped generate much stronger returns for shareholders than the furniture retail industry would otherwise be capable of generating. Now we get back to the incentives point. If your bonuses and your share options vest on revenue growth, then share buybacks definitely won't boost that, and neither will dividends. If remuneration is based on profit growth rather than earnings per share, we find ourselves with exactly the same problem where we are not incentivizing the right way of thinking about capital allocation. In fact, if the remuneration structure is based purely on income statement concepts without making allowance for anything on the balance sheet or the number of shares in issue, it is a highly flawed system that is a recipe for disaster for shareholders. It is really not difficult to make an income statement look good for a few years, or just long enough to get paid the big bucks. It is a whole lot harder to do it in such a way that doesn't also break the balance sheet. Put differently, if your friend came along and told you, hey, I started a successful business, you would probably be impressed, right? Now, if you found out that they did it with no external funding and bootstrapped the entire thing, you would probably be even more impressed. But what if you found out that they had a blank check? What if you found out that they made R1 million profit, but they ate up 50 million rand worth of capital investment to do it? That's not impressive anymore. In fact, what they've done is they've actually destroyed economic value by generating returns far below the cost of capital. And yet, corporate executives get away with this all the time because of poorly crafted incentive structures. So, next time you're reading a set of company accounts, here are a few things to look out for. Firstly, does the management team talk about concepts like return on capital and capital allocation? Or is it all market share, revenue growth, footprint? Secondly, how is management remuneration structured? And thirdly, have they been doing acquisitions? And if so, how is the group performing both with and without those acquisitions? It sounds simple, but it requires some pretty detailed work. Doing that work can be the difference between success and disappointment in your portfolio. And if you want to see a difference underway right now, look no further than Process. I've covered the new management team in a previous Supernatural Stocks podcast, and I'm enjoying more and more the change of guard there and how we've moved on from a narrative around growth at all costs and market share and not being too worried about capital allocation into a far more mature approach around capital allocation. And the latest remuneration package, this moonshot structure, is measured based on market cap over the next few years. And that is particularly interesting because if that isn't a market measure, I don't know what is. Regardless of which company you're looking at out there, make sure you are testing whether this management team knows how to allocate capital or not. Remember, it's your capital that they are allocating. There's no such thing as an opportunity without risk, and these are merely my opinions on the stocks covered herein. Make sure that you do your own research and form your own views on the market when doing anything in your portfolio. Nothing in Supernatural Stocks should be taken as advice.